Well, the markets have been volatile this past week, and a lot of us are watching them. In this week's U.S. Bank Economic 360, we are fortunate to have U.S. Bank Senior Portfolio Manager Keith Sessions in to talk about what's causing the erratic ride. He is with Business Courier Market Engagement Manager Kelly Snyder in the studio.
Thanks, Peg. Keith, thanks for being here. So it's all anybody's talking about. Can you give us a quick recap of what happened last week in the markets?
Certainly. So last week we did have a couple of big news announcements, and it caused the market to have a lot of volatility. So one day it was up almost 400 points and down almost 800 points the next.
Wow. So the headlines are talking about trade negotiations and the inverted yield curve. How do these impact the markets?
Right. So the trade negotiations we've talked about in the past, and this week or last week, the U.S. came out and said that we were going to add additional tariffs on another $300 billion worth of Chinese goods. That led to some concerns about the global markets. And then on Tuesday, we reversed course and said, okay, those are going to be put off until December the 15th. In addition, there were some key economic indicators that came out that showed that, surprisingly, China's economy is slowing. So their unemployment is rising, they're not investing as much on fixed assets, and the retail sales were down. When you looked past China into other areas of the world, specifically Germany, you saw another contraction of their economy in the second quarter. They're large exporters, so there were some concerns about a slowdown globally that was going on. Then, as you mentioned, you had the news of the inverted yield curve came out. So this is when the 2-year Treasury is paying a higher interest rate than a 10-year Treasury. And it is important to note that this was a brief period of time that we had an inverted yield curve. It was not sustained. But a lot of media outlets will come out and say, you know, this is a leading indicator of a recession. And it does happen, but it also has been able to predict 8 of the last 5 recessions. So it's not always accurate. It's important to remember the difference between correlation and causation. And an inverted yield curve does not cause a recession. It's more of an indicator of what's going on, and specifically that short-term interest rates are too high. So we have a Fed that has already reduced short-term interest rates by 1/4 point. Markets priced in another 2 interest rate changes in the next 12 months. So you can see some accommodations that are coming through here.
Okay. So what should investors look for over the next few months?
Yeah, we look at this more as a mid-cycle slowdown than, leading into a recession. And again, an inverted yield curve, it takes a long time. The average is 18 months from the time you see it to the time a recession comes in. So you start looking at the rest of the fundamental numbers. Second quarter earnings beat expectations, so those are looking good. The labor market is still very, very strong, and the consumer is still very much engaged. So all of those things are still showing positives for the economy right now.
Well, good. Keith, thanks again for being here.